Happy Friday out there, Team 42. It's your skipper here, Darius to present our macro minute for Friday, October 11th, 2024. As always, we'll start with the executive summary from today's lit off morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, will accelerating inflation trigger an inflation market regime, which is a risk off market regime? So our answers are, yesterday afternoon, the Cleveland Fed released its median and trim mean CPI time series, and both were supportive of our near three-year-old sticky inflation theme. Today's PPI report provided some relief to the developing sticky inflation narrative among investor consensus. Headline PPI, core PPI, and services PPI each slowed to below trend 3-month annualized rates at 1.3, 1.4, and 1.2% respectively. We did, however, continue to observe evidence of inflation bottoming at a level that is highly inconsistent with the Fed's de facto 2% price stability mandate via core PPI, which has been a leading indicator in this and prior inflation cycles. The good news is upside surprises in inflation are unlikely to cause problems for asset markets until the Fed downgrades the labor market in its reaction function, which may not occur until economic resiliency is confirmed by data well into 2025. Investors should expect the next 100 basis points of rate cuts to be mechanically pushed through over the next 4 FOMC meetings, irrespective of what inflation data signal. It's the subsequent 100 basis points of projected cuts by the dot plot that investors should be concerned about from the perspective of trending US dollar strength and bond market volatility, the both of which are countercyclical leading indicators of global liquidity. Transitioning to our 42 macro dashboard, as always, we'll wrap up with a question from our community. This one's a fun take on bear porn here. It says, hello, Darius and others. Just a thought. Since your bear porn crusade, BPC has been pretty active on Twitter of late. It should be active, by the way. We've been in a raging bull market that we called for and maintained our bullish view on since November 2nd of last year. Really, since January of last year. We took a brief period of bearishness in April and October as our risk management signals told us to take down risk in those moments. But obviously, we got back on the long side of risk and have generally been bullish since January of 2023, with the exception of those 2 months. So getting back into it, I wonder if it's fear that sells. Waiting for the big drop is equally or more greed thing. I think many people fantasize about being super heavy in TLT when the GFC and COVID panic slump arrived. Your holdings go up 50% while everyone else's go down 50 to 80. And then you can go max risk at the bottom and at least quadruple your net worth in a matter of weeks. That's the thing that many plebes like myself are after. And that's why we flock to snake oil dealers. Bear porn is a get rich quick scheme. Grind doesn't sell because grind sucks. Of course, the only TLTs that survive the actual bottoms are the one you told your mom to buy 20 years ago and forgot about. It is a fantasy opportunity that is clear only in hindsight. In presence, you are always nose to the wall. Wow, this is fantastic. I mean, I could have written this better myself. I mean, it does encompass a lot of the things that I believe to be true about investing in terms of behavioral heuristics, cognitive biases, and also in terms of how, for lack of a better word, snake oil salesmen or bear porn purveyors trigger people's cognitive biases into constantly approaching asset markets from the perspective of fear. And really, this person is saying it's really it's a greed thing to hopefully investors can have, so quote unquote, large pockets of capital to invest at the lows of a market cycle. But the reality is market crashes, which do occur with increasing frequency. There have been 7 crashes since January of 1998. So they have occurred with increasing frequency over the past 20 to 25 years. Market crashes, however, do recover. And ultimately, most of the time, the market is trending higher. And so your goal as an investor, particularly as a retail investor, because this is a little bit different for institutional investors, your job as a retail investor is to maximize upside capture in bull markets and minimize downside capture in bear markets. That's it. If you're constantly fighting a bull market and constantly missing out on gains, then what you're really actively doing is delaying your retirement. Your goal as a retail investor should be to retire on time and comfortably. And any newsletter or trading system or any guidance that you're receiving that delays a comfortable retirement is guidance that is, quite frankly, it's not good. It's doing you a disservice as a human. And so the reason I'm on this bear porn crusade, and by the way, at some point we're going to be bearish when our market regime system tells us to be bearish. It's our goal to manage risk at all times, whether it be a raging bull market or in a raging bear markets. We're going to do what our systems tell us to do. But the reason I go on this bear porn crusade, because in this very what feels to me obvious, very easy and obvious raging bull market. Go back to the words I was using back last November to describe the upside risk we were calling for in asset markets. It was as obvious a raging bull market opportunity as I've seen in my career. And I made it very clear at the time that it was obvious and raging. And yet so many investors did not participate in it because they've been concerned about a litany of things, the latest of which is the geopolitical consternation in the Middle East. And so at the end of the day, what these bear porn people are doing to you is bad. It's not good. And so I just want to make sure that, investors understand where I'm coming from with this, because ultimately at the end of the day, we want people to have good outcomes in their portfolios so they can have good outcomes in their lives. That's it. That's why 42 macro exists. I don't think we're the best things in sliced bread. I don't think we have everything figured out, but we have a lot of stuff figured out, and we were really good at what we are good at. And that's, keeping our clients on the right side of market risk. And to that point, I'll conclude with this, which is a secondary comment to the comment here. Says this client says, I agree. I was caught up in this as well. As a retail investor, I had no system or even understanding of what to look for when entering and exiting positions. That led me to being on the sidelines for a long time, waiting to buy the dip. Ouch. With 42 macro, I've been learning to remove any emotions and just use the signals. It's not perfect, but it beats what I was doing. I've learned a lot about investing since I've joined, and I'm really grateful to have access to this research and simple to implement system. So we'll wrap it up there. I just want to say thank you to the client. Thank you to everyone who's listening to me rant in these videos every day. Hopefully, I'm doing my small part of making the world a better place with the gifts that God has blessed me with, which is institutional finance and democratizing that to the masses. So we'll wrap it up there. We'll catch you back here on Monday. Have a great weekend.